Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Tom Callahan, CEO of Nasdaq Private Market, Laura Kayrouz, Senior Partner and Global Co-Head of Investments at Alpha FMC, as well as Scott Voss, Managing Director and Senior Market Strategist at HarbourVest. We're here to discuss practical strategies for integrating public and private market investments. It is great to have everyone with us. Welcome to Trade Talks. And Tom, that seems to be the big topic today, is the private markets and how different forces are driving the trajectory for more interest in it. What is the state of the private market these days?
Sure. Well, Jill, first of all, thanks for having me back on. It's an absolute thrill to be here. You know, I think it's helpful to maybe zoom out a little bit and let's talk about the private markets and why they matter. I think there's a credible argument that could be made that if you look at the trend of the last certainly 10 years, maybe 20 years, that large swaths of the capital markets in the U.S. are being privatized. You only need to look at the explosive growth of private credit, which I know you've talked about on your show, and also the market that we operate in, which is the private shares market, the private equity market. Let me give you some numbers that support that I think may help frame this conversation. The number of publicly traded companies in the U.S. peaked in 1996 at just over 8,000. Today we've got about 4,600. That's a 46% drop from that peak. Jill, you remember back in 2013 when being a unicorn is a big deal.
Yes.
You'd be on this show and there'd be a headline if a private company got to be a unicorn. There was about 30 at that time. Fast forward now 12 years, there's 1,500 unicorns. So there are more private companies. Those companies are waiting longer to go public. It used to be 25 years ago. Private company IPO'd at about 5 years old. Now it's closer to 15. So this phenomenon of private for longer has very, very much been with us. I think it has profound impacts on portfolios, investment allocations, strategies, because the private markets are largely an unregulated market with a lot of friction and a lot of challenges in access, and we're going to talk about that here. And it just really represents different challenges, but also incredible opportunities for investors, because some of the largest, most dynamic companies in the world right now, SpaceX, xAI, OpenAI, Anthropic, I could give you a list of 25, the most innovative, dynamic companies in the world right now are private.
Yeah, and Laura, I'm sure you would argue that technological advancements and the evolution of the regulatory landscape has also accelerated the access to private markets.
Oh, 100%. There has been a structural change, to your points. And when we look at all those years ago, a lot of the structures of those funds being heavily fixed income, equities, that 60-40 split where you were managing and doing traditional rebalancing, that's now shifting to get that access to liquidity so that you can hit the revenue targets. And then you need to have the ability, when you take in some of those different types of data points, when you look at public markets versus private markets, you have silos within the data, which brings us then to your point on technology. So technology innovation has to be at the heart of what organizations are doing to safeguard themselves so that they can also scale quickly. So you have to remove those silos through technology, thinking through the right aspects of AI, machine learning, cloud-based technology, selecting potentially some of the right vendors. I think IBOR platforms are a really big part of what some of these organizations are looking to do. And when you look at the vendor landscape and selection optionality, those are their strategies because they have to bring that to their existing clients, but they also have to bring that to build their business into their future expanded client base.
Yeah, and Scott, when you think about allocation towards the private markets, you have an interesting point here that less than 5% of companies in major economies are public. So when you're thinking about, okay, how do I access the private markets in my portfolio, and how should you be thinking about allocation there?
Yeah, so if you're a public market investor only and you're broadly diversified, like you said, less than 5% of the companies that make up the US and European economies are actually publicly traded. So if you want to participate in the other 95%, you need a private market allocation. It shouldn't be 95% of your allocation, it should probably be 10 or 20% of your allocation. But then further, when you think about how you allocate within your public market portfolio, you might have yielding investments, you might have value-oriented investments, growth, or even hyper-growth. You can allocate the same way to those types of ideas in your private market portfolio in the same way that you do in your public market portfolio.
Yeah, so it seems as if, Tom, that the risk-reward profile appears to be more attractive in the private markets.
Absolutely, Jill, and I think that's why you're seeing some of the largest, most sophisticated investors in the world that are making massive bets on this future growth of private markets. I used to work at BlackRock for 9 years. In 2024 alone, I think they spent $28 billion in acquisitions, including Preqin, which is one of the premier private market data providers. So the big players are making a bet that this trend continues, that it's where the opportunities are, but it's also where the risks are, and the risks in private markets are very, very different. At the highest level, all of public market securities regulation is based on transparency and level playing fields. Well, those rules don't exist in the private market. So if you want to buy a share in a private company, private companies don't publicize their financials. They don't put forward-looking projections. All those things that you can find in 5 seconds on your iPhone on a public stock are very, very hard to find in private markets. So there's just challenges in terms of data, of information, but also liquidity. You can't just buy a share in any private company just because you want to. There's no centralized exchange where there's always a bid and there's always an offer. So yes, there's certainly opportunities. There's incredible opportunities, but you really need to be cautious of the risks as well.
Yeah. So, Laura, when you think about it, are companies or less companies going public, with the exception of, okay, I need liquidity, I want the marketing behind it, right? If I'm listed on a major U.S. stock exchange, are those really the reasons why companies would consider going public at this point?
I think there's a lot of different factors, but I think there's more flexibility potentially for a lot of these organizations to stay private for longer, to build their business and hit growth targets, in many cases, a lot faster. And I think some of the pieces that we were talking about earlier today too is how do we then scale to hit doubling a business, tripling a business if you're staying private for 3 to 5 years. And we might see a lot of that shifting into then the technology and the R&D bucket. So for example, if we're looking at just private assets alone, you're going to see enhancements to foundational data. You're then going to see overlays with some of the machine learning that they're going to be doing, some of the compliance oversight, the regulatory oversight. We're talking about deal generation. So bringing in new deals, doing the due diligence, how to use technology to overlay that and understand the risk profile before putting that investment into a fund. And I think once that's in the fund, active, out there, available in the market, then you're going to have, for example, high net worth individuals where you need personalization. They need access to portals and data and the ability to see that daily. So that's also going to be driven by some of those external data portals to give them that kind of, to your point, instant gratification. Right. Google, look up the stock. So when I think about why clients are staying private longer, it's really to hit some of those aspirational and very important growth targets before they then can go to IPO and really have likely a more stable foundation and success factor rate.
And Scott, we saw that with the revaluations that took place in 21, 22, which I think needed to happen. And it wasn't just about putting money towards growth at all costs, where operating efficiency in the balance sheet and proper governance and listening to your advisors was key. Especially when you're thinking about going public, because it comes down, it's a public investor at the end of the day that's not going to have the same opportunities as institutions.
Yeah, there's an interesting dynamic playing out here. Ultimately, the ultimate ambition is to become a public company, but there's a lot of companies that went public that have decided as a public company they'd rather be private. Right. So if you looked at the most successful IPOs that happened over the last 18 months, let's pick venture-backed IPOs, Rubrik, more recently Service Titan, they tend to be going out at values of $5 to $10 billion. But then if you look at the largest private equity deals done, they're take privates, they're public to privates of what used to be venture-backed companies that went public, and now the largest private equity firms in the world are taking these companies private at valuations of $5 to $10 billion. So kind of what we've talked about today, public and private are very distinct markets, but the line is blurring, and kind of the advantage that the company has might change as a public company versus a private company.
Right, and I'd asked you about this off camera before. What's the significance of public and private valuations being on par?
Yeah, mean the trade happening?
Like the $5 to $10 billion valuations?
Yeah, so significance, I think the buyer of that public company probably has a longer term plan that they need to implement that factors into the value that they're willing to pay for the company. So if you look at a public to private, the buyer tends to pay a premium to what the public market price is because they are going to own that company, they're going to be active with that company, and they're going to help that company execute on operational transformation that might take a couple of years, and ultimately that company might go back public again. We saw that recently with SailPoint, which is the largest technology IPO of 2025, and that company followed the exact path I just described. Venture back, went public, private equity took it private, transformed it, and now it's been given to the public markets again at a very healthy $12 or $13 billion valuation.
Yeah. Tom, does this impact the accessibility and democratization of the public markets if companies decide to stay private longer? Because, I mean, you know, being able to access those types of investments aren't the same.
Yeah, I mean, you have to step back and ask, why do companies go public to begin with?
Right.
You know, and a big part of it is to raise capital. We saw what was reported to be the largest private fundraise in history in December 2024. Databricks did a $10 billion round as a private company. So clearly, private companies have the ability to raise massive amount of capital while still remaining private. The other reason that companies go public is for liquidity. You look at the Instacart IPO, one of the largest IPOs the last couple of years. It was 100% secondary. So essentially, you know, founders, early round investors are cashing out through the IPO. Well, platforms like ours at Nasdaq Private Market, that's what we do, is offer tenders and other liquidity strategies for companies to offer liquidity to employees while still being private. And I think it's one of the reasons why, if you take out that forcing mechanism for liquidity, for raising capital, it allows private companies to focus on their core business. And we talk to private companies, and I talk to private company CEOs all the time. They typically don't say never when it comes to the IPO, but what it means is they'll IPO when they're ready, when it makes sense for their business purposes, but they're not forced to prematurely. And one of the lessons of the SPAC boom that we all have seen is that if companies go public before they're ready, very bad things can happen. So I think there's actually something very healthy out of this private for longer trend that we're seeing.
I would agree with you, because at the end of the day, it's a retail investor that's stuck holding the bag, if you will, which decreases confidence in the capital market structure, which, you know, I think that's the biggest issue overall. But to your point earlier, private companies, because they don't have reporting or shareholder items that they have to deal with, they have the ability to be a little bit more nimble and fix their operating strategies in a shorter time.
Yeah, and I think the challenge for all of us here that are in the business of trying to make private markets and private investments more transparent and more efficient is that we need to build better data products, better infrastructure, so is that we're bringing more investors into the private market, that they have a more public market experience in terms of expectations around valuations and liquidity, and just the ability to operate in an efficient way. And I think that's the challenge that all of us have in front of us.
And if I could just jump in, I think the advantage a company has when it's private is its investor tends to be an active investor. So there's value add that's coming from the investor. And when the company goes public, those private investors tend to step off of the board and be less active in the company. So there is an advantage, I think, when you have capital market expertise sitting around the table, M&A expertise sitting around the table, that can help the company grow.
So Laura, when you think about strategies for public and private market integration, tell us how you would approach that.
I think it's about the total portfolio approach, which is on the docket for so many of our client base. And it goes back to kind of your earlier point of, well, how do you actually look at the different types of structured and unstructured data? So they are essentially looking at, well, number one, you know, I have private assets. You know, I have to take in a longer term holding, but I'm going to get a higher value. So how am I looking at cash flows? How am I looking at some of the risk returns? And then how do you actually map that data point into some more traditional assets like an equity, a fixed income product? And then you run your aggregate enterprise view where you are able to then report out to your client base, what are their risk exposures, how are you thinking about doing some asset allocations, because you're not just doing a traditional rebalance anymore, you're actually looking at other factor bases like what's happening with inflation. That's always a big topic today. What are some of the global ramifications on how you need to think about reconstructing your portfolio? So it actually allows organizations, when you take a total portfolio approach, to be more nimble and think about some of the market action items to mirror that portfolio sooner rather than later, just to wait to a particular rebalance day where, you know, back in the day, it would just be across all equities into a particular asset class. So now you have that nimble structure to work with.
Scott, is there a concern that perhaps it could be getting a bit overcrowded? I mean, private credit seems to be the darling term for 2025.
Yeah, there is a risk there because I think a lot of new entrants that are coming into private markets tend to be coming in through the retail or high net worth channel, and there's a tremendous amount of capital there that's available to invest. So even if it's only a 10% allocation in what might have otherwise been a public diversified portfolio, a lot of new capital is going to come into the industry. And I think what we're going to see is the private markets stratify, and private equity is going to be delivered to different investors in different structures, and what that investor is getting is going to look different depending on how they're accessing the industry. And the last thing I'd say, it's incumbent on us in the industry to make sure that we educate that investor on exactly what they're getting and what they're not getting.
Yeah, well, I'm glad you said that because sometimes I think investors hear ETF wrapper or fund, they have the perception that it's going to trade and be liquid like an equity ETF, and the underlying is a completely different asset.
Yeah. What I would tell an investor is if private markets is a 10 or 20% allocation in their diversified portfolio, they shouldn't think of that as the place they're going to go for liquidity. It should be the 80% that's in publicly traded securities.
Yeah.
That being said, there's liquidity features that are being introduced into some of these new structures that give investors access, but it's just not something you can sell tomorrow, and the investor needs to understand that.
Right. So,
That's a really good point, because there's a really neat data point that we can all look at. So if you look at something simple like a pension fund that would be risk adverse years and years ago, they would have 0 private assets or something as little as 4%. But when we look at even just that particular group alone, they are going 20, sometimes higher in getting access into the private space. And that is just going to be growing with you. If you look at a traditional asset manager that is going to be willing to take on even more risk. So it's definitely a dynamic change.
I would imagine it has to do with the models as well, where you're looking for assets that are less correlative. It was interesting when we were at Global Alts, we were talking about that, Tom. I had a representative from the industry tell me if there's not a part of your portfolio that you hate, you're doing something wrong. And I think that's the concern that we're seeing as the model is changing. And, for example, when bonds and equities were moving together at the same, so you didn't have that balance there. But in the last few minutes, Tom, when we think about the outlook, do you expect the trajectory for private market demand to continue?
Yeah, I mean, these aren't predictions, Jill, but if you just extrapolate out the trend lines that I talked about, some very strange things are going to start to happen in the next decade. I think the most valuable private company is SpaceX, rumored to be valued around $350 billion. If these trends continued, we'll have our first Trillicorn, a private company worth $1 trillion. If these trend lines continue, you could easily see more unicorns than publicly traded companies. So this is what I'm talking about, the privatization of the capital markets. And that's an incredible opportunity. One of the unique advantages of the private markets is it gives you really targeted exposure. Let's say right now you wanted to invest in AI in the public markets. Who would you buy? You'd buy NVIDIA maybe, you'd buy some Microsoft, you'd buy some Alphabet. Those companies are huge in AI, but they do other things too. In the private markets, we have a dozen companies, xAI, OpenAI, Anthropic, on and on. Same in crypto. Really targeted exposures to exactly what you're looking for, and that's the advantage. What I would say in conclusion, these markets are growing and are getting of such size, they can't stay unregulated forever. And there are certain baseline regulations that exist in every other asset class that I know of in terms of transparency, central clearing. These markets are going to get too big for regulators to ignore. So I think that's kind of the next wave in these next 10 years is how do we put smart, common sense regulation on the private markets to allow them to grow and innovate and not to stifle that innovation, but at the same time create some levels of standardization so all these new investors that are coming into this market have an amazing experience.
Okay, well, we have our panel topic for next time, don't we all? Thanks so much for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.